Okay, so here we go. Purchasing investment properties. This is part one of a four-part series. And I have Tyler Anderson on here that I will let him take over in a second. But I actually know Tyler from the wedding world. I photographed his wedding years and years ago. So I personally know him as being a good human being, number one. But number two, when I started off in real estate, I was at Coldwell banker in the beginning, and he was a trusted lender for many, many realtors who, are very good in the business, used him. So he became kind of a top, noticed him right away. So he is an absolute trusted lender in the business. And it was funny because it was, I don't know, a couple of weeks ago, Tyler, I think you and I were talking on the phone about a client, and he was purchasing an investment property for himself over the phone. He didn't go to the property. He was looking at the numbers. He had other people do it. And I thought, that's really interesting because I don't own investment properties yet, curious about them. And anyone who's watching this, if you're curious about them, just because, maybe you want to own some investment properties, make additional money, or maybe you're looking to decrease your taxable income. There's different reasons for that, but it just really got on my radar that he's doing this over the phone. And then I asked him about this. So Tyler owns 60 buildings and over 100 units, right? I'll let you talk about that in a sec, but everywhere from Twin Cities to Duluth to Superior, Wisconsin. And I think it's really interesting because, of course, this has been over 18 years. Obviously, and I'm sure you've seen things and have advice to do and what not to do. So we would love to hear from you on that. And one of the things that I think is interesting too, is for some of us, we're just so busy. For me, I'm like, I can't even take another thing on my plate. How would I? But I love the idea of doing it for many reasons. But you were managing them yourself. And then since, I don't know, the last year or so, you can talk about that, you now hire management companies to take over that. So I think that's really interesting. And then obviously you're using this somehow as a smart business write-off tax-wise. So somehow this must be smart. Otherwise you wouldn't be doing it because you're busy with a family and you're a busy lender. So without further ado, Tyler, I'm going to let you take over. And at the end, we will do a Q&A.
Sounds good. Well, thanks, Kelly. First, I'll just give a little bit of background on me, kind of where I'm from, how I got into it. So from Edina, actually graduated from Breck High School, went to the University of Pennsylvania, got a degree in economics. When I graduated, I had no clue what I wanted to do. Most of the people I went to college with went to Wall Street. I knew that wasn't for me. I liked finance. I liked real estate. So I got back to Minnesota and met with a good family friend of mine who owned a large real estate company in the area. And so he put me in touch with the president of a large mortgage company. And I met with her, figured out what mortgage banking was, and she offered me a job. And I said, oh, what the hell? That was 19 years ago. So obviously I've seen a lot of cycles, I've seen a lot of ups and downs. Lending's changed significantly over the time. What has been great though, is it allows me to do my true passion, which I could learn on the job. I could learn the financing of rental properties. I can learn the market movements. So I got into rental properties because my dad gave me a book when I graduated from college called Rich Dad Poor Dad. I probably read it once a year. It's a mindset book. And the premise of the book is you buy assets that produce income that pay for liabilities. And over time, you accumulate assets that pay all your liabilities, your car payments, your house, your credit cards, student loans, whatever it is. And as soon as you get to the point in life where you have enough income from your assets to pay your liabilities in perpetuity, you're in essence financially free. And that's kind of what drove me to do what I want, when I want, not have to account for anybody. So I figured, well, what's my best vehicle to do so? And I figured real estate would be that vehicle for me. And we'll go over why in a little bit. So I bought my first rental property in 2004. It was a duplex up and down Northeast Minneapolis, 3-bed, 1-bath. I paid $295 for it with $5,000 solid paid closing costs. And it was by no stretch of the imagination a home run. But you know what? It got me started, it got me growing, and it's got me learning. And if you remember back from 2004 to 2008, the market just went crazy. People were buying things irrationally, but I always bought by cash flow. And so I stopped buying for 4 years. Then remember what happened in 2008 and 2009, the market crashed. So now I'm sitting there with an asset that was underwater, but I didn't care because it's still cash flow for me. And so I took that opportunity to buy as many rental properties as I could. I mean, you could have thrown a dart at the MLS and found a good deal. It was just really easy back then. So I'd buy as much property as I could, single family, multifamily, it didn't really matter to me. And then as those values grew in value, I do a cash out refinance, buy more properties and keep going. And then I would target certain areas. So I'm a cash flow investor. So I look at the numbers. So as long as the cash flow works, I'll go there. So as soon as certain areas would go up too much in value, what I would do is just shift focus into a different area. And then that came too hot, I would go to a different area. And so I kind of get that rich dad poor dad mentality. So for every liability that I have, I buy an asset to pay for it. So I'll give you, for instance, we're having a third kid in February, and I had to buy a new car. It's a depreciating asset. Don't like to buy cars. So what I did is I bought 3 rental properties in Superior, Wisconsin. And so I put 0 down on my car, bought 3 rental properties. That cash flow, even with a 20-year amortization, more than pays for my car payment. So I do that with everything that I do. So my kids, I each bought them 5 rental properties when they were born. So they'll be paid off by the time they get to college. So now they're going to have, their college paid for. And so when my kids turn 16, I'm not going to buy them a car. I'm going to buy them each a rental property, and they're going to manage it and find a car payment that meets the cash flow. And so kind of that's my mentality, is for everything that I do, I try to have an asset that pays for every liability that I have. And my goal at the end of the day is really to have, by the time my daughter gets to college, have everything will be paid off. I have everything in 15, 20-year amortizations. So at that point, kind of figure out what I want to do from there. I guess, why real estate, one of the things I like about it is passive income. You're not going to be trading your time for money. And, within real estate, there's varying degrees of passivity. You can really make real estate as active or as passive as you want. You can do all the work yourself. You can change light bulbs, fix toilets, paint, lease it, or you can have somebody else do it themselves, or probably a management company do it. And so I switched about 6 months ago. I just stopped doing it. But I'm not completely out of it. So I still actively manage my management company. So I meet with them, once a week. I'll give them a call, see how things are going, where I can increase rents, where I can decrease expenses. So I still actively manage my management company, but it doesn't take a lot of time for me. A couple of things why passive income is important to me, and part of the reason why I buy real estate is a couple of things. Number one, it gives me freedom of time. The 2 most important people in my life, I apologize to my wife, but are my 2 kids. I have will be 7-year-old, and then a 4-year-old daughter. And I want to be an active parent. I want to be there for them. I want to go to their sporting events. If they're in theater, if they're in dance or in sports, whatever it is they want to get into, I want to be there for them. And having enough passive income allows me that flexibility to be with my kids. Freedom of time can be whatever it wants. It could be charity work, golf, whatever it is you like. It gives you freedom to do what you want to do. It reduces stress and fear of the future. So, we're all commissioned employees here, basically. And how the real estate market works. There's ups and downs, ebbs and flows, good markets, bad markets. And if you have enough passive income, it allows you to subsidize the bad months, the bad years that might be in real estate. So it allows you to kind of even out the ebbs and flows of real estate. It allows me to do the things that I love to do rather than do things to pay the bills. So if you have a 9-to-5 job with a boss that you don't like, you don't have to do that job. Even within real estate, I'm sure you guys all love your job, but you always have that client sometimes that you don't want to work with, that doesn't treat you right, that doesn't respect your time, that will, has a $200,000 budget and $500,000 taste that would drive you everywhere from Farmington to Duluth. You don't have to work with those people. So it gives you flexibility to work with who you want to work with. It also gives you flexibility to live where you want, live wherever you want. So if you don't like the Minnesota winters, well, go live in Florida for the winter. Having passive income allows you to do that. And the last thing, it gives me the platform for long-term financial security and retirement. It allows me to, be able to save up for my retirement. And let's just look at it this way. I don't think I'm going to see Social Security. I think it's going to be bankrupt by the time I get there. But just look at how one rental property can change your retirement. So you buy a rental property at 30 years old, 30-year fixed, paid off by the time you're 60. Just that one property can give you a couple $1,000s a month in income, a couple $100,000 a year, or a couple $100,000 in assets. So multiply that by 2, 3, 4, 5, 10 times. You can see how owning rental properties can significantly subsidize a good retirement for you. Next is kind of, why real estate? What makes real estate a good investment? So there's 5 wealth generators of real estate. There's an acronym that real estate investors use to describe the wealth generators. So you have, it's ideal. Real estate is ideal. The I stands for income. So hopefully people are buying properties that are cash flow positive. You have enough income to pay your expenses. Some investors don't work that way. They base on appreciation, but I buy an income. And so the income can be used wherever you want. It can be used to pay bills, or it can be able to accumulate to buy more properties, which is what I do. So I have all my rental property incomes completely separate from my personal income. And I use that totally simply for retirement, pay down debt and accumulate property. So I keep it separate. The next wealth generator is D for depreciation. So the IRS is very kind to real estate investors. So they allow you to depreciate the property over 27 and a half years. So I'll give you a good example. So if you have a rental property, 120,000, you can depreciate the building portion of that property. So you have to back out the land. So let's just say that the land value is 20,000. You can depreciate that $100,000 over 27 and a half years. So what does that do? It reduces your taxable income by $2,750. And so that will do is allow you to grow your money on a tax deferred basis, which will allow your income to grow exponentially. And I did say tax deferred, not tax free, because when you sell your property, you are going to have to pay back the capital gains and the depreciation that you took, unless you do a 1031 exchange, in which case you can push that forward and forever. The next wealth generator is E for equity. This is perhaps my favorite wealth generator of real estate. So most people who buy real estate have a mortgage. That mortgage has a principal and interest component. And so over time, your renter is literally paying down your debt for you. Most people hate making mortgage payments. I love it. Because like I said, I have 15 and 20-year amortizations in all my properties. So when I get a mortgage statement that's $1,000, I know that $500 of that just increased my net worth. So I actually enjoy making my mortgage payments because I can see it's kind of like forced savings. And I like seeing that. So I have to meet with my bank every year and do a net worth statement. And it's always fun to see how much debt that I've paid down for that my tenants have basically paid for at the end of the year. Next wealth generator, A for appreciation. So in real estate, there's two types of appreciation. One is forced appreciation. One of the great things about real estate is you can make the property more valuable. You can do landscaping, you can increase rents, decrease expenses, add a bedroom, redo a kitchen, bathroom. So there's things that you can do to make that property more valuable. Now compare that to the stock market. So if you invest, $1,000 in Tesla stock, what are you going to do to increase the value? You're going to call Elon Musk and tell him how to run the company? No, you can't. With real estate, though, you have some sort of a say in the value of the property by what you put into it. The second type of appreciation is obviously market appreciation. Over time, real estate generally goes up in value. You give it a 30-year look, it's about 4.6%, which is greater than the inflation rate. And so over time, given a long enough period, real estate does go up in value at a greater rate than inflation, and which is a great inflation hedge, because look at right now, look at how much inflation is, but real estate is going up more than the inflation rate. So it is a great hedge against inflation, because real estate over time goes up. The last wealth generator is L for leverage. One of the great things about real estate is you can utilize leverage. So on a VA, you can go 0 down, FHA 3.5% down, conventional 3 to 5% down. But I'll give you an example of leverage. So let's just say you bought a rental property for $100,000. You put 20% down, 20,000, and the value of that property went up 10%. What is your rate of return? It's 50%, because you only put 20,000 down, but your value went up by $10,000. It's a 50% rate of return. So you can see how using leverage can exponentially grow your net worth just by using it correctly. I always say use it correctly, because I don't think it's good to over leverage, but I think it's can be used correctly, a great tool to exponentially grow your net worth. A couple of things why I think why real estate works. I just discussed is it's tangible, and the owner can directly impact the performance. I've made a lot of money by fixing it up, increasing rents. So there's a lot of things that you can do to make the property more valuable. And people always need a place to live. So real estate cannot be outsourced. Amazon's not going to come in and ruin the real estate market. People always need a physical place to live. And so real estate's always going to have value. It's never going to go to zero unless you buy in a landfill or something. But as long as you buy in an area that has positive growth, you're going to see your values go up. Real estate's easy to understand. People of all educational levels have become millionaires in real estate. You don't need a PhD to figure out how real estate works. It's pretty easy. In a couple classes from now, we'll go over the financing of real estate and how to look at numbers, but it's not that difficult. Um, Real estate's passive. I spend, a couple hours a week on my real estate. It doesn't take me a lot of time. Real estate is stable for the most part. I mean, you look at the stock market, you have the, up 600, down 400, up 1,000, down 1,000. Real estate's kind of slow and steady. I mean, it kind of goes up slowly. There's a variety of options with real estate. So you can, whatever your passions are, you can buy, mobile home parks, you can buy retail, you can buy office, you can flip homes, you can buy single family, multifamily. So there's a variety of options, 1,000 different ways to invest in real estate. So whatever your skill set is and whatever your passion is, you can probably find it in real estate. The next is, I say you can find below market deals in real estate. So if you look hard enough, if you have insider information that somebody's going through divorce or foreclosure, you can find below market deals, and you compare that to the stock market. If you have information that's not public, it's insider trading. But in real estate, you can take advantage of certain situations and find below market deals. And the last thing I want to just mention on this is real estate has a proven track record. There's been more millionaires made in real estate than any other industry. It's worked for thousands of years, and people always need a place to live. So I think real estate will always work going forward. So a couple things on kind of what to do before you start investing in real estate. A couple things that I would always suggest. One is get your financial house in order. You want to get your credit to where it needs to be able to get a mortgage. You want to pay off your credit card, pay off your judgments. You don't want to use real estate to get you out of financial trouble. You want you to use real estate to subsidize your current finances. And so, you want to be able to save for a down payment. If you need $30,000 to buy an investment property, you don't want to have $32,000 in the bank. You need reserves. So just think through these things. You want to make sure that you're on solid footing before you start investing in real estate. Next thing I would say is educate yourself. I try to read every single real estate book that comes out because I just like learning about it. But there's no stretch. I don't stretch imagination. Do I know everything? But I'm always learning, and you can learn by reading books. You can learn by podcasts, blogs, whatever it is. Educate yourself. Next is networking. Meet with other investors. You learn a lot from other people, and just network. You go to meetups, whatever it is. Meet other people. They may have a deal that's not on the market. The next thing is create a roadmap. I mean, Kelly Brown Homes didn't just wake up one day and do $100 million of real estate. You had a plan, you had a vision. You do things on a daily basis to get you to where you want to go. So what I say is whatever your goals are, there's no right or wrong. Let's just throw a number out there, $10,000 a month in income. Okay, that's great. So what do I have to do to get there? How many properties do I need to buy? What time frame do I want to get there? And do the little things. This is a business. So what do I have to do daily? What do I have to do weekly? What do I have to do monthly? What do I have to do yearly to meet that goal? Create a business plan. Next is, accept that this is a marathon, not a sprint. I mean, this is not a get rich quick business. And nothing pisses me off more than seeing that guru you pay $25,000 for, so you can retire next year by buying real estate. It's not going to happen. You want to do it slowly and methodically. So always kind of keep your vision in mind, because you're going to have setbacks. You're going to have an eviction. You're going to have, a water heater or roof. That's fine. But always keep your long-term vision in mind, because one step back, there's going to be two steps forward. And the last thing I would say is take action. A lot of people never buy real estate because they have analysis paralysis. They sit and they educate themselves. They look at properties, but they never do it because they're scared to take that first step. You're never going to make money from your first transaction. You're to make it because of your first transaction, from what you learned, that momentum that you build up. So as soon as you buy your first rental property, the second, third, fourth, fifth becomes much easier. So next, just want to touch on a couple people that you should have on your team before you buy real estate. So a couple people that I always suggest. Number one is your spouse or your significant other. You need to be on the same page as your spouse or significant other. It just makes it a lot easier when you both have the same vision and you both have the same goals. And so I was lucky enough when I met my wife, I had a real estate portfolio, so she could see and I could show her kind of why I'm doing what I'm doing. But I still made her read the book Rich Dad Poor Dad because I really needed to understand my mindset. And so for people who aren't on the same page, get on the same page. Listen to podcasts together, read books together, talk about it. because you don't want to have one party want to buy real estate. You buy it, the other party didn't. You have a water heater that goes out and your spouse is telling you, see, I told you so. It's just much easier when you're both on the same page. Second person, real estate agent. You need to have a good real estate agent. You need to have a full-time real estate agent, because those deals are hard enough to get. You need an agent that can get the deal done for you. An agent that knows what makes a good investment property, what doesn't make a good investment property, what's a good area, what's a bad area. So you need a very good real estate agent to be able to navigate you through the investment process. And next, you need a good lender. You need a lender that can get you put together the proper financing for you. You need probably one lender that can do your FHA, VA conventional loans. They need a second lender that can maybe do more of your creative financing, like a bank loan, someone that can do construction financing. So you need to have a lender in place that meets your goals. Next is an attorney. Not so much for beginning investors, but as you grow, you're going to need someone to put together LLC documents, do evictions for you, read management agreements. So having a good attorney is always good to have in your pocket. Next is an accountant. You need an accountant that knows how to work with real estate investors. You don't want to work through QuickBooks when you own real estate. Like, tax codes are complicated and they always change. So you need to work with an accountant that works with investors to make sure that you're maximizing your tax write-offs. Next is handyman or contractor. This is perhaps the most difficult person to find, especially in this market here. Finding a handyman or contractor is very difficult. You either have, they're either cheap and unreliable, or they're extraordinarily expensive and reliable. It's very hard to find a good one. So you find one, make sure to treat them well. Next is an insurance agent. You need to work with an insurance agent that works with multiple carriers, because I can tell you from experience, there's new carriers that kind of in and out of the market. You need to take advantage of the carriers that want to work with you. You work with an agent that knows what deductible you need to have, if you need an umbrella policy, guide you on replacement cost. So work with an insurance agent that works with real estate investors. Next is property manager. Another very difficult one to find. You need to work with a property manager who has your best interest. That's going to try to maximize your returns. I can tell you, I've had a bad property manager. I switched property managers up in Duluth and Superior about 2 years ago because they kept nickel and diming me. They kept making up repairs, and so I probably saved $8,000 a month by switching property managers. So I didn't have those random repairs anymore. So it's very important to find a property manager that will look out for your best interests. And then last person I suggest in your team is a mentor. Try to find somebody that you can learn from, somebody that has done more than you. So if they can tell you what you're doing right, what you're doing wrong, how to grow your business. So I think a mentor is extremely important having your team. So once you have your team set, you kind of have to figure out what type of property works for you. And there's no right or wrong. I mean, some investors like single family homes, some like townhomes, some like multifamily. There's no right or wrong. I have all of them. But it's nice to be able to know what's the pros and the cons of each type of property. Single family homes, they're very easy to work with. You're going to have tenants that stay there a long time. They're stable. They appreciate. The management is a lot less. But the downside is you have a lot of competition for single family homes because you're competing against people who want to live there as an owner occupant. They don't care about the numbers. So it's very difficult to find a good cash flowing single family home because there's so much in demand right now for owner occupants. Townhome, it's kind of similar. I mean, they're very easy to work with. They have an association that basically takes care of everything. So if you invest in a townhome, not much you do. I mean, I've owned townhomes and I haven't, some I didn't see for years because they're just so easy. But the downside is, you have association dues. You got to figure out, what the dues are, and they can go up at any time. And the other thing is, the good thing is having an association. The bad thing is having an association, because the association can limit what you do. They can make you put it on a new roof. They can assess you. So you want to make sure you're buying in an association that is established and can work with you. The last, multifamily. A lot of investors will only purchase multifamily. Couple reasons for that is there's more cash flow opportunities. You can add laundry. You can pay separately for garage. So a lot more ways to increase income on a multifamily. It's much easier to scale. And so if your goal is to have 100 units, it's much easier to do with a multifamily. The downside obviously is going to be the turnover. It's a lot more turnover on multifamily. Tenants typically kind of go at a lot greater clip. And the second is you have difficulty managing. So anytime you have neighbors, you have problems sometimes. So I can't tell you how many fights I've had to deal with between an up and down duplex. So it's just a lot more management intensive. And then last thing I kind of want to touch upon here is, now that you know kind of what you buy, you want to figure out where you want to buy. Investors kind of classify properties into 4 categories, A, B, C, or D. And there's both a grade for condition and for area. And I was listening to one investor and he was saying, there's kind of a gray, there's no really defined A, B, C, or D. And an A property, he said, is a place that I want my family to live. A B property is where a family could live. A C property is where I could live if I absolutely 100% had to. And a D property, I'd rather be camping. So, but in general, like an A property is going to be in your new construction, your prime areas. But what's going to happen, you're going to get a better tenant base, but your rate of returns are going to be a lot lower because they're in a lot higher demand. Your B properties are going to be a little bit less, not new construction, a little bit older, more deferred maintenance, maybe not in the best areas, but still in good areas, but you're going to get a higher rate of return. Your C areas are probably going to be, 30-plus-year-old home, more deferred maintenance, maybe some Section 8 housing, but you're going to get a lot higher rate of return. And then you have your D properties, which are really basically classified as boarded up homes in a war zone. But there's no really right or wrong. I mean, investors kind of have made money in every single different category. So you have to kind of figure out what's going to be best for me. Do I want it easy and maybe lack the rate of return, or do I want to make it a better rate of return and maybe be more hands-on? So there's really no right or wrong. It's kind of what's right for you. And a couple of things that I look for in an area, I look for crime and drugs. Obviously, crime and drugs, higher vacancies, not as great of tenants. That's one thing I look for is crime. Look for schools, better school districts, higher rents. Obviously, just like in real estate, people want to buy and live there where good schools are. Now I look for unemployment rates. It's not really a huge issue right now since unemployment rates are relatively low. But higher unemployment rates just means more vacancies and less rent. I look at diversity of employment. What I mean by that is I don't want to buy in an area that has one employer. So if you buy in an area where the military base is the only employer and that base goes away, you're kind of stuck. So I look for areas that have a variety of employers, whether it be private sector, public sectors, hospitals, schools. So I try to look for areas that have multiple employment bases. Population growth I look for. Obviously, where if there's population growth, you're going to have higher rents and less vacancies and vice versa. I look for transportation. People like to live and have easy access to transportation. Kind of look what happened with the light rail. People like to have easy access to transportation. Proximity to local businesses. People like to live by where they work. There was one investor who his goal was to always buy properties near a Starbucks. And his rationale for it was Starbucks spends millions of dollars a year and figure out what the best areas are. He goes, why don't I just take their research and buy where they buy? Not a bad idea. Another thing I look for is price to rent ratios. And what I mean by that is I won't buy in an area where I can't find homes whose monthly rent is equal to 1% of the value of the property. Now, what that means is if the area has the property is $200,000, I want a minimum of $2,000 a month for income. It doesn't mean it's good or bad property, but that's my barometer. And if the area can't support that, I won't look there. And not every area has that. So you got to find areas that meet your cash flow demands. Next thing I look for is population size. I look for at least 100,000 in the metropolitan area because I want to have a diverse rental base. I want to be able to have multiple property management companies I can work with. I want to have multiple handymen that I can call on. If you buy in too small of an area, you're kind of limited in what your options are. And then the last thing that I look for, and this is kind of more recent, is city regulation. That's a big one right now. Minneapolis is very difficult. You can't, discriminate on renting to people with eviction histories. So there's certain cities that have a lot of regulation on landlords, and look what happened in St. Paul. You have a 3% cap on what you can increase your rents for. So I think before you buy in an area, you really have to understand the regulations of the area where you're purchasing to make sure that's going to, fit your business model. So that's about all I got right now, Kelly.
Love it. Thank you for that. That was a lot. That was a lot of good
Went through
stuff.
it fast, so sorry.
No, but that's great. I think all of us realtors, many of us are like, we're busy, like we want that information. And obviously this will be recorded. That was great. I think one of my super cool takeaways is obviously I haven't done this yet and it's on my radar, but for you, even I have teenage kids. I love how you, instead of paying for a car or whatever you decide to do, you're going to buy them a rental property that they can manage, figure out, and use that income. Use that money for, I think this kind of stuff is brilliant. So I love it. Let's open this up. Any questions? Let's do a Q&A for five minutes here of Tyler's time. So unmute yourselves and go ahead and shoot, ask questions.
I have a quick question.
Yep.
Do you suggest, we have 5 rental properties and we're considering putting them into an LLC. Is there a pro or a con to that?
Yeah, that's a question that I get a lot, and I know a lot of investors, hem and haw about. So it depends. Speaking as a lender, I can't advise this, but a lot of people will purchase in the individual name because you have to for Fannie Mae, Freddie Mac, and FHA, and then quick claim it to an LLC. That's a lot of people certainly do that. I have all my properties in LLCs because my wife's an attorney and she's the most risk adverse person in the world. But so the kind of the pros and cons are, if you get sued, your liability is limited to the properties that are in the LLC. They can't boil over to your personal. So, but what a lot of people do is they'll buy in their individual name and they'll have a big umbrella policy to cover them. So you can get an extra $5 million of coverage on your individual policy, which, increases the cap. I mean, the probability of something happening to get over $8 million, if you have, 2 million of standard and you get an extra 5 for 7 million, that's something bad would have to happen. But so there's really no right or wrong. It's whatever makes you sleep better at night. So there's ways to do it both ways. You can do it both ways. I don't know if that answers your question or not.
That helped a lot. Thank you.
Yep.
Hi, Tyler. What is your viewpoint on purchasing vacation properties as rental properties to start out on?
I like it. I don't do them. I think you need to buy it in a way that that can, my biggest issue is the city can come in and basically tell you we're not going to allow rental properties or vacation rentals anymore, which certain cities have done that. So that's my only fear. As long as it cash flows on a long-term basis, so you can fall back on it if the city says you can't do long-term rentals. So my opinion is great as long as if you can get a long-term renter that still works for you, and then you can always maximize your the income doing vacation rentals. I know a lot of people had a lot of success on that. The other downside is it's gonna be more management active, so it's just gonna take more time for you. Which is if you have somebody that does it, that's great. You're gonna pay higher management costs as well. But I know a lot of people have been very successful doing it. My only advice is just to make sure that it cash flows long term if they ever restricted vacation rentals in the area.
Okay. Does anyone else have a question? Oh, okay, I got a follow-up question. So, and what? Sorry. So, what's your percentage for that you would take out for maintenance and vacancy from the rent?
That's a dang good question. And you talk to 10 different investors, you probably get 10 different answers. So the qualify depends on a couple things. It depends on the age of the house. So when I buy a property, I always get an inspection, and if there's a lot of deferred maintenance, I'm gonna add more for daily or maintenance costs. So I typically use on a multifamily, as long as the work has been done up front. When I buy a property, I kind of fix it up where I can. I'll do between 1 and 150 per unit per month for repairs. That's me. Now, in a new construction, if you buy a property, you completely fix it up, well, then you can maybe use a little bit less. So, between 1 and 150 per unit is what I use on my multifamilies.
Okay. All right, great. Thank you.
Yep.
Okay, I have a question, Tyler. Okay, so for your rate of return, what are you looking for a rental property?
So my kind of goal is I look at cash on cash return. And so I want 12% cash on cash return using a 20-year amortization. That's a lot to ask, I know, but I can typically get those numbers. That's just what I look for. I mean, it's no right or wrong on that at all. I mean, every investor has different goals. That's just what I use. And again, that gives me some room of using that matrix. If things were to happen to the property, because there's always more expenses than you sometimes anticipate. So I give myself a little cushions why on paper I pencil out 12. And if it comes to 10 or 8, I'm still perfectly fine with that because I have a 20-year amortization that will add a 10% return on top of that.
Okay, guys, any other questions? We're gonna let Tyler wrap up and we'll do part 2 later. Anything else?
I just have one more. Okay, so for the rental properties that you're buying, is it better to buy them like all cash offers, or is it better to finance? Sounds like financing may be the better route.
It depends. I do both. I typically do financing on mine, but sometimes what I'll do is if the property is distressed, and I'll give you an example of one that I did. Well, 4 months ago, I purchased a property. It was $76,000, and it was in Superior, Wisconsin. The seller owed $76,000 in taxes, so I bought it. I had to pay cash for it. So what I did is it needed about $26,000 worth of work. Paid cash for the work. I got my appraised value at $155,000, and I did a cash out refinance. Took out all the cash that I had into it. Basically, had zero into it, and then still cash flows $400 a month for me. So in situations where I can do a significant value add with cash, then put a mortgage in afterwards to recoup all the money that I had into it, I will definitely do that. But a lot of properties you can't do that with if they're already in working order. Those typically work better for distressed properties. I don't know if that answers your question or not. But.
Yeah, no, it does. Thank you.
Yep.
Hey, Tyler, what is your viewpoint on taking hard money loans to get started in investing, or would you rather beginners save up for cash for the down payment?
That's a hard one. I've never really used hard money. I know sometimes it's the only option. My advice on those, if that's your only option, great. I would use it as a last resort because obviously it's high interest rates and high points. And you need to have you really need to work on your numbers on those type of properties. You need to make sure you have a very strong exit strategy. So you need to work with if you're doing rehab work, you need to really trust all the parties that are involved in the transaction. You need to trust your contractors to get the work done on time. You need to trust your after repaired value or ARV to make sure that you can get your cash out when you're done. Because after a year, I mean, it's a lot of interest and a lot of expense. So that would just make sure you have a good exit strategy.
Okay, great. Thank you.
Yep.
Okay, guys, thank you. Tyler, a couple things I was going to ask. It seems like you just mentioned a property under 100,000. Just in general, the properties that you're buying, do you have a strategy as far as price? Do you buy over 400? Do you try to keep at a certain price?
I don't have any strategy as long as the numbers work for me, to be honest with you. Sometimes you see in the bigger units, though, you don't quite get the numbers for the smaller ones. So sometimes I'll buy a portfolio as a deal. So I bought a portfolio of 7 college homes 2 years ago. So sometimes I'll package deals up and do one transaction with them. But I certainly buy things that are, there was a package I lost out on last month that had, 5-unit to 7-unit, 4-unit, all in one. Each property is about 400,000. So yeah, I look at anything as long as the numbers work. It doesn't make zero difference to me.
I've never heard that wording package. So how would you find out about a package? Is these off-market deals, or how do you find out?
Off-market. Yeah. So the agent that I work with, had a client that was tired of managing rental properties. So he owned 7 properties, and it was just easier for him for one investor to go in and buy them all instead of having to sell to 7 different investors. So what I do is I typically give myself a discount on the package because it's easier for the seller to take a discount and just buy them all.
Interesting. And I
Oh.
noticed for you own more buildings rather than single family. Is there a reason for that?
No, there's really no rhyme or reason. It's just whatever comes up, whatever works best for me. For some reason, the last 4, I found single family homes that I bought. Just whatever's on the market that works. I don't really care.
Got it.
So maybe next month a bunch of multifamilies will come up that work for me, right?
Okay, great. That was so helpful. Thank you for doing this. We will
Yep.
do the next one. We'll do part 2 of the 4-part series. I'll put that on Instagram and let you guys know when that is. But thank you very much, Tyler. Really appreciate
you.
it.
Appreciate it.
Thank you.
Take care.
Thanks, guys.